Okay, hi everyone. Thanks very much for joining us for this Minerside chat. So you've been introduced to the CEO of Equibit Group, Chris Horlacher, but I wanted to give you a couple of notes just to preempt the conversation. So Equibit Group has designed and developed a blockchain specifically for the capital markets, which means that they've designed a dedicated network for the trade and issuance of crypto securities. This chat is called a Minerside chat because Equibit produces a series of videos on YouTube that explains Blockchain 101 and also does a really good deep dive into their tech. And finally, and most notably, earlier this year, Equibit Group successfully completed an atomic swap with good UX, which is really important. We know that as an industry, UX is going to be really significant in the engagement and adoption of this technology. So we'll get started. So Chris, you had an early eye to cryptocurrency, and back in 2010, you were CFO of a securities brokerage, and so you really well understood the issues that plague the back offices, and you saw that Bitcoin could provide a solution. So what I wanted to ask you is, how have you seen blockchain for finance evolve since then, and where do you see the industry going in 5 to 10 years?
Well, what I realized with Bitcoin in 2010 was that Satoshi Nakamoto had built essentially the world's best real-time gross settlement system. And in the back offices of banks, you'll be very familiar with that sort of a system because that is what many banks use for domestic settlements. International settlements work a little bit differently, but it's still essentially the same mechanism. And here we had a network protocol that could do the same thing rather than an entity with people and procedures and fees involved. So I was really intrigued by this because it changed the entire paradigm for how a financial system could operate. Where up until now, the whole system was based on faith and trust in institutions. It was completely turned around. And your security at this point is no longer dependent upon building a walled garden and keeping the wrong people out. It's in ensuring that the majority of the people using the system have good intentions. And that was a really interesting proposition that has a million applications. As someone who worked in the financial markets, really, for me, if it could work with a single homogeneous asset, i.e. cash, why couldn't it also work for many other kinds of intangible assets like securities were the first thing my mind turned to, but also insurance contracts, licenses, IP, patents. There's a lot of potential use cases for this technology. And of course, I'm specialized in the financial markets, and so that's what Equibit became. Mm-hmm. And specialization is definitely one of the key tenets at Equibit Group in terms of how we work with the technology, because it is inefficient, but you can deal with that so long as you have a very focused use case.
So you were talking about use cases, and your background's in the capital markets. So what problems, what issues specifically within the capital markets do you see blockchain solving?
Well, my big problem as a CFO was the experience with depositories and transfer agents. And so if you've ever worked in a back office at a exchange or brokerage, then you probably know what I'm talking about. Many people I find in the securities industry don't know that because they come from the middle office and the front office, right. And the back office is usually this black box that paper goes in and other stuff comes out, mm-hmm. and nobody's quite sure what goes on there. But what's going on is it's going out to transfer agents, and the registry of securities that they maintain on behalf of the issuers is eventually updated, and this is where T+2, T+3 comes from, mm-hmm. Because when all of these executed orders arrive at the doors of the transfer agent, they have to churn through this mountain of paperwork, and it takes time to process all of this. Mm-hmm. And this model of doing it was installed in the 1970s with dematerialization and centralization. And it solved a problem that this industry was experiencing in the moment, in that it was doing essentially decentralized settlement at the time. But with the volume of executed orders now, it was choking on its own output. That model could not scale. So we centralized the custody of everything and centralized how it was all being processed, and we were able to limp forward for another 50 years, and that brings us to this point now. And once again, now, there's so many companies, there's so much transaction volume, and again, we're bursting at the seams, and we need to change paradigms again. And this is what we can achieve with blockchain technology, is the removal of these central choke points and a streamlining of the entire infrastructure, bringing issuers and investors directly together, doing direct registration where investors have true, indisputable legal title, which they do not have right now.
Right.
If you own stocks in a brokerage account, the issuer does not know who you are, and in an insolvency, it becomes very difficult to find you because there's all of these disparate records across many different organizations that all have to be reconciled to figure out who the true owner of the security is. And there's no shortage of problems due to this. If a company declares a dividend mid-trade, say it's T+3 settlement and you're T+1, a dividend gets declared, who gets that dividend?
Right.
So these are all problems that there's many processes that have been cooked up to deal with this now, but it's, if you solve the problem at its source, strike the root in that we're not doing immediate settlements, then much of these procedures become obsolete. And so it's, it removes a gigantic cost component from the industry. Mm-hmm. So if we look at custodians, we look at the transfer agents, altogether there's 500-600 of them in the world, and they cost the investing public somewhere in the order of about $20 to possibly $40 billion a year. Wow. To run this infrastructure. So the blockchain, or a blockchain like Equibit, that disintermediates this system can really help with the cost savings and increase investor protections, market transparency, openness, and drastically improve the liquidity. So
speaking to liquidity, Chris and I were just chatting backstage about the various applications of blockchain technology for the capital markets and securities, the tokenization of securities and the platforms that are discussing what that'll mean for liquidity in the markets. And so you're talking about the eradication or the removal of third parties, intermediaries that are causing complexity. And we were talking about that leading to liquidity. If you could just touch on that a little bit more.
Sure. So the big issue with liquidity, a lot of it has to do with transparency. Now, this is not a huge problem in the public marketplaces, but as many of you are probably aware, the public marketplaces are only a sliver of all of the companies that are out there. We have the pink sheets of unlisted public companies, and then we have a huge amount of private companies that dwarfs the number of publicly listed companies out there that many investors, accredited or not, have no idea are out there. So it's very hard for those companies to access liquidity. And in a public blockchain, that problem disappears. Everybody essentially is connected to a real-time global pink sheet where they can see all of the public securities, all of the private securities, and they can find willing sellers and buyers to do an atomic swap with. And we've constructed a wallet that leverages the Equibit protocol alongside other blockchain protocols, the immediate present where we're integrating with Bitcoin, so you can do atomic swaps between the two. But as you mentioned in our demo, we have it on our YouTube channel, and in a matter of minutes, we have a demonstration of a company opening up its wallet, its Equibit wallet, receiving some Equibits, registering a common share, putting out an ask order, and selling it for Bitcoin to someone, could be next door, could be on the other side of the world. Doesn't matter, they qualify to buy the security and execute that atomic swap with them, receiving the Bitcoin, the purchaser receives the common share, and this is all done in a matter of minutes with nothing but an Equibit compatible wallet.
Super exciting, and a super exciting development for the industry. So you were talking about complexity, and so I wanted to go back to discussing some of the announcements that have recently come out of Wall Street. And we know that market opacity did have an effect and was a factor of the recession 2008-2009. Given Wall Street's recent announcements, we know JP Morgan is looking to do swap trading with Bitcoin. And so I wanted to ask you, how do we make sure that we get this use of blockchain technology for finance right and the use of crypto assets right, so that we don't create over complexity again?
Well, we need to remember or keep at the top of the mind what blockchain is. And it's not a database, it's a network protocol. And it should be synonymous with something that is open, permissionless, and transparent. Many projects who approach blockchain with just the database mindset, they've missed the point. They've taken cryptography lessons from something like Bitcoin and applied it to a centralized database. Now, I'm not gonna challenge doing that, because that's good. We need more secure databases. However, they're blurring the lines between an actual blockchain and a more secure database. And both things are now being billed as blockchain. So as consumers or investors, we want to make sure that we have the knowledge to notice the difference between the two. Whenever somebody says, oh, hey, we're doing something on the blockchain, my first question is, all right, can I mine it? And that's a really good litmus test to tell whether you're dealing with just a database or a real blockchain protocol. And a real blockchain protocol is the big paradigm shifting technology. And there's another speaker by the name of Andreas Antonopoulos who talks at length about this, and he says that if you receive a proposition with blockchain in it, and you can just do a find replace of the word blockchain for the word database, and the whole proposal still makes sense, you're probably not being given something all that revolutionary. So that's an important thing to remember. And we've been, with this new paradigm shifting technology, all of the excitement and the jargon, there is the potential for the misuse of terms, and we've definitely seen that with the word blockchain. Another one I'm seeing emerge now, though, is tokenization. We're going to tokenize the world. We're going to tokenize real estate, or tokenize, fractional assets. And, really the synonym for that is securitization. And that's actually a very old thing, where you create a fractional proxy asset for something in the real world. So, a tokenized real estate it's a real estate investment trust. It's not new. Maybe you've registered the security in a different way. It's not sitting in CDS now. Maybe it's sitting in a smart contract or on something like Equibit. But at the end of the day, you haven't really done anything particularly new. You've just changed the name of what you're doing. Sure.
So there have been a number of different projects looking to solve the issues that the capital markets have with blockchain technology, and a number of them have chosen to use Ethereum smart contracts to solve that. Equibit Group instead has chosen to build a dedicated network to solve those problems. So I'd love to ask you why, and if you could tell us a little bit more about that.
Well, this goes back to one of our other tenets of blockchain development at Equibit Group, and that is specialization. So because we have this very inefficient system that can't process tons of transactions per second, we have to choose very carefully what kinds of transactions we're going to route through it. And we didn't, when we first started out on this project, we did consider Ethereum as a possible platform, and writing Equibit just as a smart contract. But the more we observed and researched into Ethereum, the more we moved away from it, realizing that a general purpose system, something as they call it Turing completeness, and it's something that can run for, you can put a program on it that will run for a theoretically indefinite period of time. It may never stop, and you don't know if it will ever stop. That to us presented a problem from an infrastructure and a security perspective. And that seems to have borne out because we've seen things like CryptoKitties, where a single application
clogged the network?
It clogged the network, and it happened even before CryptoKitties with the status ICO. And Turing completeness, having it completely open-ended in terms of what the network will allow you to submit to it, opens up a lot of attack vectors, and we've seen that as well with the DAO hack and the parity, not necessarily a hack, but more of a bug, maybe
sure.
a bug
Okay.
or a mess up. But so that's those were problems, and coming from the securities industry, I didn't think that a shared infrastructure would be the most trusted way for issuers and the financial institutions, because they wouldn't want to be exposed to the risks that might be coming in from the gaming industry, for example. So a dedicated, specialized blockchain, it's simple to understand in terms of how it works and what it does. That was our focus. And when you look at the business, if you just look at business in general, if your business plan is, I'm going to build a company that does everything, that you'll have a hard time finding investors for that. Mm-hmm. And so, businesses everywhere in business, we have specialization. We have focus on one particular thing. I build, the bottle, or I make the cap that goes on the bottle, or I print the label that goes on the bottle, and then somebody else goes and gets the water.
So you're doing one thing really well.
Yeah, it looks like it's one company, but there's actually 5 or 6 companies that probably came together just to make that bottle of water.
Totally. So we were a little short on time. I've got one more question that I've been really wanting to ask you. So we've seen this industry take some of the concepts, cryptocurrencies, particularly Bitcoin and blockchain, in some pretty far-reaching directions. I'm sure all of you can think of some sort of audacious things that you've seen. So I wanted to ask you, what would you say is the true value proposition of these technologies and their most effective implementation?
Well, it has to do with how we build network infrastructure and the way society handles its data. Because over the last, basically over the course of human history, we've had, we're in sort of the third monetary age. We started off with commodity money, and we used things like seashells and salt to represent value, and we traded that around, and that worked okay, but the salt, you ate it, and the other stuff kind of rotted, or it didn't work really well. But then we figured out gold was actually a really good commodity, so we started making coins out of gold. We standardized the weights and measures. Things continued to evolve. We had a really good monetary system for centuries. And then the governments came in and said, hey, we're going to manage this now for safety, security, stability. And then they took that over, and then they took away the gold, and then we went from a commodity-based money to essentially using government debt as money. And that began basically in the 19th century with the creation of the Federal Reserve, really after 1971, after the world completely unhinged its monetary system from gold. That was when we became a pure debt-based monetary system, and we've just seen the value of currencies collapse ever since. Now, with Bitcoin showed us how to monetize data and do it in a way that we don't have to trust anybody whether or not the data we're receiving is true. We can validate it all for ourselves. Every one of you in the audience can know for a fact whether a transaction has occurred or not. And that fundamentally changes a very important social agreement in humanity, one of the oldest ones, because money predates writing, if you can believe that or not. It's one of the oldest technologies there is. And it was created so we could keep track of our stuff and know who owns what. And that's something we really take for granted because we have so many monetary technologies out there. So the big value proposition is in the fact that we can all participate in this infrastructure now. We can support it and secure it with nothing more than a child's toy. a GPU, something you play video games on.
Yeah.
So we've taken the cost of securing our financial markets and we've brought it right down here, and we've opened the field up so that everybody can become a part of it and everybody can know the truth for themselves. And that, if you're not doing that with blockchain, then you're not doing it right.
I think that's a pretty powerful note to end on. Thank you very much, Chris.
Thank you.
Thanks, everyone give it a hand.